So unfortunately, every single one of these scenarios is done on a case-by-case basis, right? No two deals that I've done are alike, right? Unless they are with the same people and involve the same assets, but it's relatively rare. So if you needed $40,000, the first piece would be, what do you need it for? Are you purchasing an asset? Do you need it for cash flow, right? Because if you need it for cash flow, maybe you just need a line of credit that's going to revolve every 3 months. But if you need that $40,000 to buy assets, well, now we need to take a look at the useful life of the asset. That's going to determine how it's going to be repaid, right? Because some assets, their useful life is just different than other ones. If you're buying a commercial building, that useful life on it might be 20, 25 years. If you're buying a tractor or something, or a piece of equipment, that machinery might only have a useful life of 5 years. So the repayment of that machinery is going to be usually done on a 5-year basis, but that repayment on a building is going to be 20, 25-year basis, right? So it really depends on what you're doing. If it's a mix, then a lot of times what we'll do is we'll just carve it out. We'll take a look and we'll say, okay, you need $30,000 in loans to buy this, these pieces of machinery, trucks, equipment, whatever it is. So I'm going to amortize that, right? That's going to be your payment terms. I'm going to amortize that over 5 years. But then you need $10,000 in working capital because you need to keep the lights on and the people paid and everything like that while you're trying to generate revenue using the assets that you purchased. So we're going to break it up. I'm going to give you a $30,000 asset loan. I'm going to give you a $10,000 line of credit. There's your $40,000. So it really depends on how you do that. Now, as far as what the interest looks like, what you need to know there is that these different lending products and tools, they have different structures. Anything that's kind of going to be like the asset side of it, like a term loan or like the building that you buy, that's going to be on a fixed interest rate for the most part, right? Unless you're getting the SBA involved, because the SBA normally they mandate variable rates. But for the most part, that's going to be on a fixed rate, and that rate's probably going to be somewhere around low fives if you're a startup business. Low fives, high fours, right? If it's a revolving line of credit, that's going to be variable, almost like your home equity lines, like your credit cards, because that's what they are. They're revolving. It's usually priced off of prime, Wall Street Journal prime rate, which is about 3.25% right now. And then they'll typically, a bank will add 1.5% on it. So you're probably paying anywhere between 4.25 and 4.75 would be the interest rate on something that is a line of credit fluctuating to support your working capital needs. And working capital is basically the day-to-day needs of the business. Like I said, keeping the lights on, buying inventory, floating receivables, paying for the lease, paying your employees, those kinds of things. So hopefully that answered that. What type of capital is most appropriate? Again, this goes, we talked about this basically the whole slide. It's your capital stack, right? It goes back to what kind of control do you need? It goes back to what type of capital can I get? What works best for me? Do I need just a debtor? Or do I need somebody who's an actual partner that can throw in with me, that can help me work the day-to-day, operations of the business? So you have to, again, that question calls back to knowing who you are. All right. Okay, so moving to the next one, external funding. So this is an area that is a little bit confusing for some people because of, over the last, probably not so much over the last 5 years, but prior to that, especially when we're talking about the early 2000s, there were so many things out there, and you probably have seen them and heard them, all these different types of advertisements and schemes and programs and things like that, where they basically say, hey, look, you start with, you use other people's money to buy things, right? Use bank money, use this money, use that money, or whatever. Those don't get but so far. For the most part, you need your own skin in the game, especially if it's debt. If you're looking to borrow, you're going to have the money in. It's just that simple, because we need, as creditors, as bankers, and like our stockholders and shareholders expect of us, we need to have, and we need to understand that you basically have that you're in it with us. That basically you are not going to walk away, at the first sign of trouble with this, right? We ask for usually 10 to 20% skin in the game, because if we finance it, think about it. If we finance something 100%, it's really easy for you to drop the keys off. It's super easy. So think back to the 2007, 2008 timeframe, the beginning of the Great Recession, and all the issues with all the houses that people bought. And if you bought a house at 100% loan to value, or even sometimes 103% loan to value, 105% loan to value, because the institution that was lending you the money also lent you the money for the cost to close the transaction. How difficult would you say it was for those people when things got tough, when times got tough, to just show up at the bank and just drop the keys off? It was pretty easy for them to do because they didn't have any money in it. They didn't have any skin in the game. So that's one of the big lessons that was learned back in 2007, 2008 timeframe. Was learned a little probably too late, but unfortunately, when you silo or bifurcate the lending structure, and you have mortgage brokers versus actual mortgage servicers versus actual mortgage holders, when you silo it like that, as it turns out, there can be a lot of issues. And I'm not blaming anybody for it. I mean, it is what it is. Humans are going to do what you allow humans to do, in particular. So, if somebody came along and said, hey, you can have 2, 3, 4 houses and generate all this additional revenue, why wouldn't you do it? Especially if somebody was saying, hey, we'll pay for the whole thing. You just sign on the dotted line, lease it up or whatever, and then you get this additional revenue coming out. So you see that. We saw that, but I think we hopefully learned our lessons from that. We need to have skin in the game. The SBA will require skin in the game if you're doing an SBA loan, right? But we want to make sure that there's a conversation before you throw the towel in, right? So if you've got skin in the game, you're typically not going to come to me and you're not going to drop the keys off and say, forget my 25% or 20% in or whatever, and forget the asset. I'm just going to walk away. Typically what will happen is you'll come and you'll say, here's what's going on. What can we do? And so that way it creates a dialogue between the vendor, creditor, and the borrower, right? That dialogue where we can work something out, because in a lot of instances, if you just went to the creditor and said, hey, I need to, something's happening, I'm having a difficult time here, I'm in the red, I need to restructure, do something, a lot of times they're going to work with you because they don't want you to go under, right? That's not how, a rising tide floats all boats, right? It doesn't work well when your clients start going under, right? No one wants that. And I'll tell you right now, contrary to what you see, popularly in media and in other places or whatever, banks do not like taking back assets. We hate it. It's one of the worst experiences in the world, because as soon as a bank takes an asset back, look, that's not what we do, right? We deal with money. We borrow money, we hold money, deposits, and then we lend the money out and we get the money back. But now if all of a sudden I've got a dump truck, what am I going to do with that? Like, seriously, people, what am I going to do with that, right? I need to call an auction house, and I need to say, hey, look, you need to get this dump truck off my hands because we don't need a dump truck at the bank. And so the auction house says, okay, well, we'll put it at auction. Well, the dump truck is worth, I don't know, $30,000. What am I going to get for it? Probably 10, maybe 5, right? Nothing. It doesn't, we don't want it. And the same thing works with, the same thing's true with properties. A lot of people think that a lot of bankers realize their profits on selling properties, but that's not truly the case. Potentially if you're a huge, large financial institution and you can buy up a bunch of properties and you can spin it out onto another company and you can sell it as if it doesn't look to be a bank, then maybe. I've heard of those things happen before, but your small regional community banks cannot do that. When I get a property, right, if somebody comes and drops off the keys to a property for me, the first thing I do is I ask them not to. The second thing I do is I say, look, how about we give you 90 days, 120 days, we'll go interest only so you don't have to pay any principal back. You try and sell it. You put it out on the market, you try and sell it, and then we'll go from there. Because if I own it, if I take possession of it, I'm going to get pennies on the dollar. Nobody's going to want to give me what it's worth. And you all know it's true, right? Because we've all seen the programs out there that talk about, oh, you need to get the short sale properties or bank-owned properties or bank-possessed properties. Where do you think all that came from? Is when the banks did take that stuff onto their balance sheet and they were like, we can't unload it, right? Nobody wants to pay what it's worth. So that scenario very much exists, especially for the small community and regional banks. So the last thing I want to do is have anybody drop off any asset whatsoever, other than the cash that I borrowed or that you borrowed. If you borrowed cash, you're going to bring that cash back? Okay, no problem. If you bring it back in the form of a dump truck, not awesome. So anyway, moving on. Sources of personal funds here. You can see here cash savings. Home equity is a big one. So especially back before the 2008 timeframe, right, when a lot of people were getting these huge home equity lines, right? Because what was happening? Property was appreciating. So you saw all this throughout the early 2000s. You saw all these properties appreciating and appreciating and appreciating. And again, it was one of the things that ended up getting people into trouble because these banks would increase the availability on these home equity lines. And so before you know it, when everything went sideways, then they started cutting these things back, and some people had the money to repay them, some people didn't. Get a little bit of a mess. But a lot of times, if you do have equity in your home and you have the risk paradigm to use it, a lot of times it is some of the lowest funding or financing that you can actually acquire. So friends and family, but you got to remember friends and family comes with strings as well. You just know that if you don't do things a certain way, Christmas dinners can get complicated, right? So we got to think about how it is when you lend someone or a family member in particular money, right? Or, do you want, if you're borrowing money from a friend, do you want to put that friendship at risk, right? So I know personally, and I have lent money to people before. I've lent money to family. I've lent money to friends. Whenever I do that, I've always had an agreement with myself that is money that I'm willing to set on fire. I will literally put the money on the ground and I'll set it on fire. If I'm willing to set the money on fire, right, then I don't really want it back. And if it comes back, that's great. It's gravy. Happy. Awesome. But I personally need to know that it's not going to negatively impact my cash flow at all. I'm not going to have any emotional ties to that money. So, and just be cognizant of that. If you do have to borrow off of friends and family, please set it up front correctly. Just let them know that they are investing in something that they may not see again. It just may not come back. You have to be honest about that up front. That way you avoid all those potential troubles on the back end. Again, you don't want to have uncomfortable Christmases. They're uncomfortable enough. All right, credit cards, that's a big one. Again, the only thing you need to really be concerned about with credit cards is how it's going to impact your credit, how it's going to, what's the interest rate on these credit cards, right? But if it makes sense, credit cards are the number one way that people finance their business, okay? So if it makes sense, do it. In today's market, would it be wise or foolish to finance my business with an equity loan off my house? I have about $70,000 in equity. So again, it really depends on your level of risk acceptance, right? Some people just cannot stomach putting their home on the line. If something were to go wrong and they would have to liquidate, would they be willing to lose their home, right? So it really is up to you. Like I said, that's probably some of the cheapest financing you can get, because a lot of times these home equity loans, they're going to be in the lower percentage, especially if it's a home equity line of credit. That might be prime minus a quarter, which is 3%. That's going to be some of the lowest lending that you can get, not to mention it churns. And these lines are sometimes 15, 20 years, right? Or maybe they give you use of it for 10 years, but then amortize it over another 10 years on the back end. So they're excellent vehicles. The problem is, if it goes bad, are you okay with knowing that you have to either term it out, get a job, and then repay it over time, or if it gets so bad to where you go into bankruptcy that they're going to have to liquidate your house in order to pay off that debt. So it really has to do with your level of acceptance of risk. So moving on, equities and stock portfolio. As far as if you've got, and unfortunately it's rare, that you have someone who has a large enough marketable securities account in order to collateralize it. But this is some of the other great stuff. Let's say that, again, you go in deployment, you're saving money, you're putting it in the stock market or whatever, right? You've got a marketable securities account like TD Ameritrade or something like that. A lot of times they will let you collateralize that. So let's say you get $100,000 and you in the marketable securities, and you say you want to borrow $50,000 against it. A lot of times they'll do it at pretty low interest rates. Now obviously that carves off, and a lot of times that either can't be traded or it has to be managed funds. So it has to be traded by someone else, not you. But it's usually pretty low interest rates on that, 3-4%, with no fee. So if you can do it and it makes sense for you, you've got the liquid assets, then it's a consideration. Retirement accounts, that all depends on how you can do it, right? So a lot of times, let's say, if you've got a TSP, a lot of times if you hit a certain, you can take funds out of that, but you're going to take funds out of that and you're going to have to pay a penalty. So you can do that, and you got to remember that it is your retirement that you're dealing with here. Now, your retirement itself can't buy into your business unless you structure it a certain way. There are some, for those of you who maybe this makes sense, there are some law firms out there that have found ways to create it so that, let's say, I see this happen a lot with pilots. Pilots amass a huge amount of retirement pay. And then what they'll do is sometimes they'll hire an attorney who will take that, they'll create businesses, C Corps, and then LLCs and S Corps underneath the C Corp. And then the retirement plan buys into the C Corp, and the C Corp owns the LLC and the S Corp. And so they're able to structure it that way so that if you were starting a business or if you were purchasing a business, you could go ahead and do that using your huge retirement account. A lot of times those retirement accounts are in excess of $1 million. So I've seen it happen. It's expensive. You can do it. It is an option. If you've got that available to you, it may be something to look into. I don't see it often. I think I've seen it happen 2-3 times in my entire career, which is spanning 20 years or so in banking. So it's out there. You can potentially do it. But for the most part, if you are going to tap into your retirement account, if you're below the age of, 55 or 60, then you're going to pay a penalty, a 10% penalty. So you're going to pay ordinary income tax and a 10% penalty. So if you're already in an effective or marginal tax bracket of, let's say, 20%, now you're going to pay 30% on that. So every 100,000 you pull over, you're only getting 70 grand. So you just have to be cognizant of that when it comes to retirement accounts. From a banking perspective, we can't use retirement accounts. There are laws put in place that say that we can't collateralize a bank loan with retirement assets. We're just not allowed to do it. And you got to look at it from, the greater society's perspective on that. Could you imagine if you, collateralized somebody's loan with their retirement and that loan went bad and you liquidated their retirement, and so now they don't have a business anymore and they don't have retirement anymore? That would not go very well in the eyes of the public. So it's not as if banks would ever want to do that. But I know that, I've had a lot of customers and clients come in and say, hey, I've got this $600,000 TSP. Can you just use that? I cannot use that. Banks cannot use your retirement accounts. So, all right. Go to the next one. All right, so debt financing. So we do look at a couple of things here, right? They've got 8 C's of credit. I typically look at about 5. I've seen some banks have like 20 C's of credit, right? It's all just policy guideline stuff, right? But notice the first one, right? The first one's credit, right? Especially if it's a new business, right? Or even if it's just new to that bank. Remember, the only way that we can tell how you're going to pay your bills as a new business is looking at your personal credit. Right? It's the thing that's going to be most indicative of your behavior. So first and foremost, get your credit in order. I'm not saying that you're not going to get a loan if your credit is a little dicey or has some blemishes. I'm just saying if you want to have a much smoother ride, get your credit in order. All right, capacity, its ability to repay, that's going to be outlined in your cash flow. So when you do your business plan, that's going to be in that cash flow. It's going to show that, hey, I'm generating this amount of money at the bottom, and it's going to be able to pay this back. And if it shows a deficit, that's where my loan comes in. So if there's a deficit in your cash flow, that's okay. There's nothing wrong with that. That's what we expect. That's the reason you're coming to me for lending. So if it shows that there's a negative at the bottom line, okay, I'm coming in to help finance that gap, right? And then just somewhere down the line, it flips from red to black, and now you're starting to pay me back, okay? So don't be afraid of having pro forma projections that are in the red. I get pro forma all the time where people just think that they're going to make money right out of the box, and that's it. Like month one, they're in the black. You talk to any business owner, typically month one, you are not in the black, right? Because think about it, you've got all these expenses up front, right? And so typically you're coming out in the red pretty good for good several months before you hit a break-even point, and then you start generating revenue. So don't be afraid to show the red. All that shows is the need. Capital, money going into the business. So again, that's the capital stack, right? Are you doing it with equity or are you doing it with debt? Obviously, there's going to be some equity no matter what because you need to have skin in the game. Is it going to be all equity? Is it going to be partially equity, partially debt, depending on how, what the needs are and what you can stomach? Again, knowing yourself. Collateral. So you saw this they talked about this in the video a little bit as far as collateral. Our shareholders expect us to lend on opportunities that have multiple forms of repayment, not only cash flow repayment, but collateral repayment, right? We always, at the bank I work at, we always consider all loans in the perspective of three repayment sources. The primary being cash flow, typically. The secondary being, realization of collateral, right? You take your security, you sell it off, liquidate it, or whatever. And the tertiary would be, other sources of income. Typically, there's other assets on the balance sheet. Typically, there's other income coming from another area, that kind of thing, whatever. But we try and make sure we've got three areas of repayment if we can. Character. So look, a lot of these other things speak to character. And we're not going to know your character if you're walking in off the street. You have no idea who you are. You don't know who we are. There's a little bit of initial trust going on, but I've got to prove myself to you as much as you've got to prove yourself to me. It's just that simple. So I'm going to take a look at your credit because that's going to speak to your character, right? That's going to tell me the kind of person you are. That's the kind of person who pays money. I'm going to take a look at your skin in the game, right? That's going to tell me the kind of person you are and how much belief you have in your business, right? I'm going to take a look at the quality of your business plan. I'm going to sit down and have a conversation with you. I'm going to learn what you know about the business, right? Because that's what I want to know how smart you are on your business. You need to be the smartest person in the room on your business. Right? That all speaks to character. Conditions. So obviously, we're going to take a look at the economy, finances, right? This normally doesn't have an impact unless there's something going on in the broader community, right? So how many loans do you think were made to hotels last year? Right? Probably not a lot, right? When it came down to it, what banks wanted to take a chance on a hotel when people are not traveling or weren't traveling, or a good percentage of that revenue was on meeting spaces and people can't meet anymore. Everybody's doing it this way, right? So we do have to look at the broader implications in society and what's happening, right? We do have to look at what's happening with the economy as far as, are we in an area of inflation like we are right now? So are people going to potentially be out to eat less? You know what I mean? That kind of stuff. And we take broader looks at things and whatnot, and you'll know what's going on, and that'll be addressed in your business plan, So your business plan is going to hit a lot of these. So, if there is something broader or greater going on in society, I'm going to look for that in your business plan. If you don't mention anything about the pandemic and how it impacts your business and your business plan, you didn't do enough homework. You need to mention, and because maybe it doesn't, but if you address it up front, you tell that that creditor that, hey, I know this is a concern. It's not a concern for me, and here's why: because I found a way to make N95 masks on my own, that are approved by OSHA, blah blah blah, whatever, and everybody needs them. And so I'm not going to have any I'm not going to have any down days. Right? Pandemic's not going to impact me negatively. So you just have to address that and have that in there. Commitment, your ability and willingness to succeed. Commitment is a lot of times going to be, I'm going to gauge commitment by skin in the game. I'm going to gauge it by credit. I'm going to gauge it by your business plan again. And lastly, but most importantly, cash flow. Can it support the business debt and expenses? Again, cash flow. We don't expect your cash flow, especially if you're a starting business, to be what you expect it to be up in the front. We understand cash flow is going to be stressed in the beginning because it takes time to get your business up and running. Even if you're adding another product line, or even if you're opening a different location, there's a lot of reasons why cash flow would be stressed. You just have to show, here's what's happening. This is why my cash flow is impacted. This is why I need your loan. And this is when I'm going to get to a point where my cash flow is going to correct itself and I'm going to be able to repay your loan. So, all right. So equity funding. Right? The last time we took a look at debt, we kind of went through some of the debt stuff and the different types of loans that there were, obviously bank loans and SBA loans. And just one big thing that I want to mention about the previous slide is that the SBA typically doesn't make loans on its own. Usually they go through banks. Last year changed all of that. Actually, 2020, the SBA started making some EIDL loans, and those came directly from the SBA. But prior to 2020, SBA never made any loans. Okay, they did all their loans through banks. But then 2020, again, atypical scenario. So they ended up making some EIDL loans. But all the PPP stuff, all that went through financial institutions. Every 7A loan goes through a financial institution. Every 504 loan goes through a community development corporation and a financial institution. So if you're looking at potentially doing an SBA loan, just know that you're normally going to be working with a bank. All right, so equity funding, the other side of the capital stack. We talked about debt, now we're talking about equity. We've got a couple examples here, crowdfunding, which is just growing in popularity exponentially. Angel investors, venture capital, private equity, we're going to talk about all these. All right, so crowdfunding, right? Definitely one of the newer ones, has been around since the 70s, right? But still just gained a lot of traction with the internet, right? So a lot of times you're able to trade some cash or to get some cash for some ownership, or sometimes even just for a tchotchke. Like a lot of these companies are coming out and they're saying, who's big one with this? I think distilleries and breweries are doing a great job of being creative and saying, hey, you know, we need some startup funding. And so, you know, we're going to give you a hat. We have like a cool, you know, whiskey hat or T-shirt or something like that. And so people are kind of like buying this in, you know, they're saying, hey, I'm going to give you $10 or $100 or whatever. And I expect down the line, I'm going to get a hat or something or whatever it is. You know, there's a lot of creativity here. You can do a lot of different things. So it's not just ownership. Sometimes it's you providing a service or something like that. So there's a lot of stuff that can be done here. The upsides of this is not only is it super creative, but just think about the platforms that you could use to get this out. The message is so expansive. It's so prolific and grand that that part of it, that is its strength, is also its weakness, right? You can get this great thing, especially if you've got something that's very ingenuitive and is, you know, easy, but not like, you know, think about it. It's something that's real easy, but doesn't it doesn't take a lot to get into, right? That kind of thing. If you put that information out there, somebody can just replicate it, right? Especially if you don't have any patents or copyrights or trademarks or anything like that, then someone can replicate your idea and they can just jump with it, you know? So just keep that, you got to be cognizant of that. Keep that in the back of your mind, you know, that if I'm doing something, you know, you're not going to put the ingredients of the secret sauce out there, right? You're not going to, it doesn't make any sense. At the same time, like I said, you can get exposure to so many people you would have never gotten exposure to, and you can ask for less upfront. So, you know, a lot of times when you're dealing with financiers, when you're dealing with bankers or whatever, you know, you're asking for that big lump sum, 100,000, 200,000, whatever, blah, right? You go there, you make a presentation, you're asking for 200,000, you're getting that lump sum. This way, you know, maybe you're not getting that 200,000 that way. Maybe you're getting it through, you know, 200,000, you know, a $10 savings, right? But and you look at that and you say, well, wait a second, how am I getting, or 20,000, right? How am I getting 20,000 investors, right, to do that? But as soon as you get it out there in that expensive network, you can do that. And there are websites even set up to help you do that, you know, so that you get that idea out there and you can get it. It's a lot easier to get $10, you know, from 20,000 people because of that level of exposure through one of these websites than sometimes it is to get 200,000 from one person. So just be cognizant that's an option out there. Angel investors. This is a really neat thing that you know, rose over the last several decades. And a lot of times these guys are mostly philanthropists, and they're very, very successful in the industry already, and they just want to help. So all they want to do is they care about the industry, they care about business owners, they want to help people expand, they want to help people succeed, right? And so I see all sorts of forms of angel investors. Some of them invest their time, some of them invest their resources, their distribution channels, their knowledge. You know, some of them do invest money. I've got some angel investors that I work with who bring me new businesses, new aspiring business owners who come up with great ideas, and they don't want to put their money into the project themselves. So what they end up doing is they come to me and they say, Ray, I've got, as you know, I've got a couple $1 million in the bank with you. I believe in this company. I want you to collateralize one of your loans with a little piece of my cash, 100,000, 200,000, and go ahead and make this loan to them because I believe in them, right? That's a very, very easy loan to make. And that's a form of angel investing, you know? And then they a lot of times they'll work with the business, they'll introduce them to people in the industry, things like that. So it's got some tremendous benefits past what you, past what comes with the money and what you would expect. All right, venture capital. So again, we've all seen the Shark Tank thing, and that's kind of like how this is. I used to work with some venture capital companies back when I was a banker in Philadelphia. They were a couple of floors above me in the corporate building I was in. And these guys are, you know, they are the leading experts a lot of times in their field, right? They're financiers who know they specialize in the industry that you're working in. So when you go and you make a deal with them, a lot of times they know exactly what you do and how people have done it in the past successfully. So a lot of times they come with very, very sharp terms, right? They say, hey, look, I'm going to be in it for, I'm going to give you $200,000. I'm going to have this amount of control. And this is the covenants that are going to be required in this particular deal. And we're going to be out of the deal with our return on investment, 40%, whatever they say, and we're going to be out of the deal in 2 or 3 years, that kind of thing. So they come with basically a lot of times all the answers of the entrance and the exit strategy. So it's interesting stuff, but you know, the reason why it makes such good reality television is because it is kind of geared towards like reality television. You know, this isn't a lot of people, not a lot of folks use these guys if you can, if it makes sense. Okay, great. But a lot of times you're going to be paying a lot and you're going to give up normally a considerable amount of control. And, you know, in the worst case scenarios, you know, we've seen where venture capitalists have taken over the business entirely. Hopefully that's not the case, but you just need to know that the risks that are potentially out there. That's all right. So here's some key takeaways, right? Plan for future growth. Where are we going to see that plan? It's in your business plan. I cannot reiterate how important it is to make sure that that business plan looks good and that you know everything in it and that you have not paid someone else to do it, that you are doing it yourself. I'm going to end on a quick story about a borrower that came in to my office and asked for a couple $100,000. And I said, okay, well, show me your business plan. I took a look at their business plan, and I looked at their business plan. It took me about 5 minutes to figure out that something was way off. I took a look at them, and they were a salon, and they were doing about top line revenue about 300,000. They were doing bottom line of about 20, 30,000. And the next year, their projected year, they all of a sudden were doing 3 million with bottom line of about 900,000. And I said, wow, and it grew exponentially year after year from thereafter. And so I said to them, I said, so can you explain to me what's going on here? I just took a look at your business plan. I see what's going on in the pro forma. I'm taking a look at what you're doing. It looks like you're going to open a school here. And how are you going in the first year from here to there? And, you know, I mean, a fair question, a pointed question, but a fair question. And so they gave me kind of a puzzled look, and they took their business plan back and they kind of looked at each other and they're kind of paging through it. And they said, well, you know, we're not sure. We paid someone to do this for us. As it turns out, these two individuals paid someone $12,000 to give them something that they couldn't use. They didn't know what was in it. And they couldn't explain it. They most certainly couldn't use it to get a loan. I had to send them back and say, look, do your best to get your money back. But it's not real. It's not relevant. It has no sense of like realistic expectation, and you didn't know what was in it. So, you know, that day, obviously they didn't get a loan. They had to go back and they had to retool it themselves. And I don't know entirely what happened, but I know they were embarrassed, and it wasn't my intent to embarrass anybody. It was just that, you know, there was no way that I could make a credible decision based off what they had turned into us. So, you know, don't get yourself caught up in that. Make sure that you know what's in your business plan. Again, it is your map, right? It's your map and compass for your land nav. All right, you need to have everything in it. Okay, that answers all the questions. Most times people can show up on my doorstep, drop off the business plan, and the next conversation that we have, I know just about everything. It's great. It's tremendous. And we can work something out. So I just want to tell that little story. Don't get caught in that. Make sure you know what's going on in your business plan. Need to know how much control you want. Again, we talked about this. Just know yourself. Understand how much you need. Again, that will be laid out in your business plan because we'll see that in the cash flow. So the cash flow will support what your needs are. Business plan is a must. Okay, I guess I beat that dead horse. And some are suited for startups and others growth. So that's as far as funding streams. Some are better suited for startups and others are for growth. Sometimes, your SBA funding stream is going to be better for a startup, especially because you have to compensate for some of those C's that you're lacking, right? The collateral one, maybe the cash flow or that kind of thing. And others may be for growth. Maybe it's a business, again, that's just extreme, that is experiencing extreme growth. And so in that instance, it might make sense that you are talking to venture capital, you are talking to crowdfunding, that kind of thing. So that's it. That's all I've got for you guys today. If there's any questions, please feel free to send me anything that you need. Again, I'm still in banking, and I get questions from people all the time, and I do this. I'm going to put my email in there, and I'm going to put my phone number in there because, again, I do this because I love the military. I love banking, and so this is the perfect intersection for me. So I often host a lot of lunches and just informal conversations with people. It doesn't matter if you're going to stay in the Hampton Roads area or Virginia, or you're going to go back to Colorado, or you're going to go to Texas, or you're going to do whatever. If you have any questions, if you need any help, we're brothers and sisters in arms, please, by all means, reach out to me because as far as being a trusted source, I am going to be the no-nonsense bottom line up front. I'm going to give you the answer that you're probably not going to get from other financial institutions because a lot of times I'm going to give you that no BS answer. I'm going to give you that bottom line up front answer that says, hey, look, here's your situation. Here's what you got to do to get around this. And I'm going to tell you why the financial institution is requiring that or doing that and what might be your best, your most successful line of effort trying to move towards your goal. So don't forget about me. Like I said, feel free to email me. Feel free to call me. I would love to help any of you. And like I said, it doesn't have to be in the area. I don't care where you are. You give me a call. Hopefully I can help you out. Again, thanks for your service and good luck with your businesses. Hope to see you on the high ground. Have a good one.
But let's go ahead and get started back in. For this next module, we have Mr. John Charlton helping us out. John's been helping us with this program for over 8 years now, almost 9. And he was vital for rebranding this and kind of restructuring this program today, the Business Plan Bootcamp. Him, Sabrina Davis, Sharitha Gordon, who's a part of our team before, and myself, we all kind of sat down and redid this thing, kind of took it from scratch and redid it. So, John, thank you as always for doing that and for volunteering your time. Say thank you to your wife for letting you do this as you are retired, and I know how that goes. So, thank you again as always, and I will let you take it away.
All righty. Good afternoon, folks. It's so good to have a bunch of people back. Let me do that work. That work. All right. Try that. It worked so perfectly before, Troy. Can you hear me? Troy, I can't. Wait a minute. Maybe now.
Yeah. I can hear you. Hang on just 1 second. Let's try this again.
Because it worked perfect. I don't think I hit anything.
All right. Let me mute myself and then I'll pass it over to you.
All right. Not so good. It was fine. Whoops.
Here, John, when you take control, just click on the slideshow one time and then you should be able to do it.
Okay.
There you go.
All righty.
All right, let me mute.
Okay. Without boring you, I try to keep this short. I was a banker for 35 years. Started in New York City, working for, at that time called one of the major money center banks. I completed a 2-year training program, which was facilitated by the Columbia Graduate School of Business. They tried to stuff accounting, finance, as much of it as they could while you worked full-time supporting lenders in the field. And it was a very, very lucky opportunity for me. Since leaving the training program, I have been a commercial lender, a team leader. I have been a chief lending officer for several financial institutions, chief retail officer, and ultimately my last job, I was the chief operating officer for 3 community banks, which has given me experience in real estate lending, commercial lending, consumer lending, retail distribution, which is branches, ATMs, online, etc., loan workout and recovery, service quality, bank acquisition and consolidation. And I became a bug at the end about leadership and management training because I had been so fortunate to have some great teachers that it impressed me that continuing that for folks you work with is very important. Come on now. Back. One more. There we go. Today, our objectives. We're actually going to walk through and start a business. The first step is we'll talk about creating where you go to get good information, how you organize that information, how you then come up with assumptions so that you can build numbers, so you can test your concept of starting your business. Then we're going to put together a cash flow. Then we're going to look at a profit and loss statement. And last but not least, a balance sheet. When this is in person, I don't let anybody not participate. I'm asking for your participation because most of the time I don't get to see your faces. I guess what I want to impress to start, if you are very serious about starting a business, it's your money. And what we're talking about right now is managing that money. How to do that, what kind of questions to ask. One does not need to be an accountant or a finance major, but you do have to understand how cash flows through a business, how you manage money, etc. We're going to start something near and dear to my heart. In retirement, I would say it was just retirement, but that's crazy. I am a wino. I love wine. We're going to start a wine and tapas bar and actually walk through a cash flow. But first, where do you get the information? A primary source I would suggest is the SMA, which is the Statistical Marketing Analysis prepared by the United States government based upon the 10-year census updated with algorithms and various key information that allows them to adjust those financials on an annual basis. Other sources, the Small Business Administration, who is a supporter of the program, of this program, produces government business data and statistics. A separate document, the Census Government, Census.gov, the American Fact Finder, FedStats.gov. My tongue's not working well. 3 things I strongly recommend, having been part of the program, and I guess I forget, Troy, but I think last time I checked with you and Don, the program has established, I think, over 400 successful businesses. interviewing existing business owners that are in a field that you're looking to go into. A couple of the folks that have come through the program that I've worked with have spent 6 months to a year working with folks to actually understand how their business works. Will everyone do this for you? No. But there are folks who will say, I understand, sure. And you may get a real opportunity. If you're going to sell wine, you might want to go talk to people who sell wine to restaurants, wine and tapas bars, just to get feedback from them, understand the process, et cetera, et cetera. And commercial real estate brokers want to sell you something, lease you something, but at the same time, they're a pretty good source of information about location, its impact, demographics, cart counts, et cetera, et cetera. Okay, in putting information together and using the sources what we've suggested, we, the group that helped me put a wine and tapas bar together, the first thing we looked at is who are we going to target as our clients' customers. We decided after lots of research, and I would say to you, count on 6 to 12 months to gather quality information, put together good solid numbers so you can build cash flows and you can build the material you may need to make you comfortable, people who may invest in your business comfortable, and certainly if you're going to be borrowing money from private sources and or banks, you're going to need quality information that can be relied upon. We focused in on the 30 to 55 years of age. We focused in on women, females. We have a mess of folks out there. Some feedback. You can speak up if you'd like, or hit some numbers and send them to me. Why would we focus primarily on women? Don't be shy, folks. There are no dumb answers, just a question that you didn't ask that you wish you had. No takers. Yeah. We focused on women for several reasons. One, statistics show women tend to drink more wine than men. Target wine moms. Wine moms, I like that, Derek. We also, after thinking about marketing and selling and sales, a funny thing happens in general. Women tend to attract men. That doesn't mean there couldn't be a place where just women tend to congregate, but women showing up at a wine and tapas bar or a bar tends to generate men who come to socialize also. The criteria that can be analyzed can get endless. Relationship status, we didn't focus on, but it could be you get into a business where you want to focus on single individuals, married folks. You may want to focus in on folks with a certain income level, et cetera, et cetera. So relationship becomes a piece to look at. Education, only, this was a long discussion with three or four folks that were involved with me. In that we didn't want it to sound like snobby, like if you only have graduated from college, do you drink wine, which is silly. It was more, some of the folks I happen to, and my wife, she's not nearly as goofy as I am. I do all the goofy stuff with wine. And some of that came from one, to get through college, I worked in a bar in New York when I was growing up. 18 was the drinking age. So beer and wine was something I got involved with a long, long time ago. And I'm an old fart now, but I haven't killed myself drinking. So that education, it's the swirl, it's the sniffing, the cork, and all that nonsense. Sometimes, depending on the quality of the wine you may be selling, could have an impact on how you deliver your product to your customers. Household income, household, not a person, two people, but the amount of income generated by household. The SMA breaks that out for you. We focused between $65,000 and $150,000 household income. That can be two people making $35,000, $32,500 to get it to $65,000, etc. In today's world of disposable income, that's a place where folks on the way home on the weekend hopefully are going to visit our establishment. Home ownership, renting or owning. In the rate environment, up until about 18 months ago, renting and owning was kind of a mixed bag. Rates were so low that housing was all of a sudden, whether you rented or owned, wasn't as big a deal. All of a sudden, as the Fed started to rattle the chains about rates going up, and homeowners' homes were not being built because of COVID, the demand for housing got crazy, and home prices got crazy. So this factor may be something, as you analyze a business, that is changing. We looked at 3 to 5 years of own or rent because it's a stability factor. The geography we looked at are the zip codes that are broken out here. We talked about religion. There are groups, sects that sometimes do not tolerate alcohol. We decided it wasn't something we were going to worry about in either direction. I'm very fortunate. I have 3 grown children and a son-in-law and a sister-in-law, daughter-in-law. And they're all very smart, and we're part of gathering information and talking about some of these factors. Where you are generationally, Gen X, millennials, etc., is critical. Interesting for someone who likes wine and frankly likes hard alcohol from time to time. And also, I play a reasonable amount of golf in retirement. I also teach a couple of different things. Millennials don't like wine in general as a group and don't like golf, which was very concerning to me as I thought about what may happen in the next few years. But those kinds of factors are things that are appropriate to find out as one looks at investing your money in your business. Also, the SMA and some of the census stuff breaks down by households, the amount of average savings, the amount of CDs, checking accounts, people having 401k relationships. Generation and life stage, in both cases, are very similar. Life stage sometimes ties in buying habits, and became the reason that we also focused in on the 30 to 55-year-olds. Yeah, old turkeys like me do drink wine, but we're more likely to do that, but maybe not several times a week, whereas the 30 to 55-year-old crowd probably does. And we decided ethnicity wasn't a factor for us to look at, only because it was the communities we're looking at very diversified, and it would not seem to impact what we were doing. If you have a question at any time, please either turn on your mic and speak up, send me a message. One, it helps everybody else that's listening. Two, when I can't see your faces, I can't go, oops, they're not getting that. And the one thing I will tell you, that lending as a banker and understanding what works and doesn't work in managing a business, it is the questions you don't ask that can get you in lots of trouble. Location analysis, where are you going to put your business? We are going to talk about a site, an internet site, a website, but for fiscal locations, not with a PH. Visibility, view, its visual impression. These factors have changed quite a bit over time. When I first got into banking, banks were boring, unattractive, kind of like big giant safe deposit box looking things. That's changed. You can deposit checks with your phone. Most folks don't go into a bank a lot. Cash is becoming a questionable item on how long it'll be around, etc. Access, whatever, if it's retail, wholesale, a service business, ease of getting into your location, ease of being able to see it, visibility for signage, just being able to see the building, parking spaces, clutter. Don't forget government regulations in all of the areas I have been a banker, which is more than a few. They change, they're not the same. Here in Hampton Roads in Virginia Beach, Norfolk, Chesapeake, and Portsmouth, the Chesapeake Water Authority and the Army Corps of Engineers have a lot to say about construction, closeness to water, impacting water and various wildlife is a big deal and a big part of things you must be cognizant of in making a decision about purchasing ground or leasing ground. Signage, its visibility is the big one. Of course, it's got to be not only visible, but easily acknowledged. I know it's goofy, but traffic patterns. There is many of you may not be from the Hampton Roads area, but in this area, there was a young man who moved to this area about the same time I did and opened up Why Not Pizza, which Why Not backwards is in the correct way is Tony. Why Not Pizza is a very successful 6 or 7 locations. You don't want to be on the going into work side in general for being a pizza store. You want to be on the way home so that you can pick up the pizza and bring it home to the family, bring it home for yourself, et cetera, et cetera. Those kinds of patterns and visibility. And this is where the commercial real estate people can be of great help. They actually have information on car counts, at certain times of the day, broken down by hour, so that you can see going in, going home. For all of you who may someday sign a lease, this is an important thing. Please don't forget it. CAM. Anybody know what CAM stands for? There are about 16 of you, so if somebody did, I'd be really surprised. It is not normal. But if you're going to sign a lease, it's something you have to be very aware of. Don't be shy. The initials CAM, Common Area Maintenance. If you lease space in an industrial park, which is in a series of buildings attached, or in retail areas where the buildings are attached and there are common area requirements for the landlord to maintain, he shares those expenses typically, unless you negotiate some of them down or out, like replacing heating and air conditioning units, which may be on the top of the building, or if we have a crazy winter and there is some snow or ice, taking care of parking lots and getting sand down. Those charges are not broken out, are broken out separately and are not typically acknowledged to you under the rent number. Many people, when they get their first bill from the landlord, go, "We agreed to $2,000 a month and I've got $2,250. And the $250 is your share of the common expenses for that month, that quarter. Something to be very aware of. Typically in a typical lease, it may be on page 17 and in a little paragraph buried in the back of the lease. So before you sign a lease, one, be aware of this. The questions to ask: what has been historically the common area charges? You'd like to know what they've been for the last 3 to 5 years, and what's your estimate, Mr. Landlord or Mrs. Landlord, on where that number's going in the next few years.